Welcome back to Centrelink Insider AU, the channel that makes sure you get every dollar you are entitled to in retirement. If you are new here, subscribe right now and turn on notifications because we cover Centrelink, the age pension, superannuation, and wealth strategy every single week. And share this video with every couple you know who is approaching retirement age, because the September 2026 deadline I am going to describe today affects them directly, and the planning window is closing. Now let us get straight into it. Before I walk you through the September 2026 changes and what couples need to do before that date, I need to make sure you understand something fundamental about how Centrelink treats couples that most Australians get completely wrong. And understanding this is essential for everything that follows. Centrelink does not assess each member of a couple individually for the age pension. It assesses couples as a single financial unit. When Centrelink looks at your age pension eligibility, it takes every asset either of you owns in either of your names and adds it together to form a combined total. It takes every source of income either of you receives from any source and combines it. The combined total is then assessed against the couple thresholds. Centrelink does not give each of you a separate asset or income allowance. It assesses your combined resources as one unit, regardless of whether you keep your finances separate or whose name assets are in. This has profound implications for retirement planning that most couples have never properly thought through. The first implication is that an imbalance in assets or super between partners creates a hidden Centrelink problem. If one partner has accumulated significantly more super than the other, the larger super balance is fully counted in the joint assessment and is generating deemed income under the income test from the moment the superholder reaches pension age. The imbalance itself is not a problem from a wealth perspective, but it creates an assessable income concentration that can reduce the couple's pension entitlement more than it would if the same total super balance were distributed more evenly between the two of them. If one partner's super balance is significantly higher than the other's, rebalancing through contribution strategies over time can reduce the combined deemed income and maximize pension entitlements. The second implication is that the age difference between partners, if one exists, creates a specific and time-sensitive planning opportunity that disappears the moment both partners reach pension age. We will come back to this in detail because it is one of the most powerful opportunities available to couples before September 2026. The third implication is that couples who separate their finances in the belief that keeping assets in one name or the other will somehow reduce their Centrelink assessment are mistaken. Centrelink adds up everything both of you own regardless of whose name it is in. Half the combined income and assets is allocated to each partner for assessment purposes, but the combined total is what determines both eligibility and payment amount. Splitting assets between spouses does not change your pension entitlement. Now let us look at the current thresholds that apply to couples, because knowing exactly where you sit against these numbers is the starting point for every strategy I am going to describe. From the 1st of July 2026, updated thresholds apply. A couple living together who own their home can have combined assets up to $499,000 and still receive the full pension of $1,810.40 per fortnight combined, which is $905.20 per person. That is approximately $47,070 per year for the couple together. The part pension cutoff for a homeowner couple combined is $1,102,500. Between those two figures, the pension reduces by $3 per fortnight for every $1,000 of combined assets above the lower threshold. A couple who does not own a home has higher thresholds. The full pension threshold for a non-homeowner couple combined is $766,000, and the part pension cutoff is $1,369,500. For the income test, a couple can have combined income up to $396 per fortnight before the pension begins to reduce. The income cutoff for a couple is $4,016.80 per fortnight combined. For the income test, Centrelink uses deeming for financial assets. The combined deeming threshold for couples from 1 July 2026 is $110,600. Any combined financial assets below that figure are deemed at 1.25%, and everything above it is deemed at 3.25%. Now, the September 2026 context. The 20th of September 2026 is the date on which both the part pension cutoff thresholds and the income test thresholds are simultaneously reviewed and updated again. This is the second indexation of 2026, following the March and July updates. When the September thresholds are confirmed in the weeks before the 20th, every couple in Australia whose combined assessable assets or combined income sit near any threshold needs to understand their new position and take any action before the changes take effect. For couples with combined assessable assets between $900,000 and $1,100,000, the September update to the part pension cutoff may be the difference between receiving a small but meaningful part pension and receiving nothing at all. For couples with combined assessable assets between $450,000 and $500,000, the September update to the full pension threshold may affect whether they receive the full pension or a reduced part pension. Now let us talk about the 5 specific things that couples approaching retirement need to do before September 2026. And I want to be very precise about each one because the details determine the outcomes. The first thing is to calculate your combined assessable assets accurately using the 1 July 2026 thresholds. This means sitting down together and making a list of everything both of you own. Every super balance at its current value, every bank account, every term deposit, every managed fund, every share portfolio, every investment property at current market value minus any investment debt secured against it, every vehicle, everything. Add all of those together to form your combined assessable assets total. Then compare that total to the updated 1 July 2026 thresholds for your situation. Are you below the full pension threshold of $499,000 combined as a homeowner couple? Between the full and part pension thresholds? Above the part pension cutoff? Knowing exactly where you sit right now tells you what the September update could mean for you, and whether any action is worth taking before that date. The second thing is to check and, if necessary, rebalance your super contributions before the end of June 2027. And I want to explain why this matters so specifically for couples. From the 1st of July 2026, the non-concessional contribution cap has risen to $130,000 per person per year, and bring forward rules allow a person to contribute up to $390,000 over 3 years by triggering the bring forward rule in the first year. If one partner is under pension age and their super balance is significantly lower than the other partners, contributing up to $390,000 into the younger or lower balance partner's super account using the bring forward rule moves those funds from the assessable environment into a potentially exempt accumulation environment and can meaningfully reduce the couple's combined assessed assets and deemed income. We do not count you or your partner's superannuation in the income and assets tests if your fund is not paying you a superannuation pension. The accumulation phase exemption is only available while the superholder has not yet reached age pension age. This strategy is therefore time sensitive. Once the lower balance partner reaches pension age, the opportunity to shelter assets in their exempt accumulation super closes permanently. The third thing is to check the downsizer contribution rules if you are aged 55 or over and you own your home. The downsizer contribution allows you to make a one-off super contribution of up to $300,000 per person, $600,000 combined for a couple, using proceeds from the sale of your principal home. Crucially, downsizer contributions are not subject to the standard super contribution caps, and they can be made regardless of your total super balance, subject to the $1.9 million transfer balance cap. However, and this is where the Centrelink interaction becomes important, a downsizing superannuation contribution may affect your income support payment. If one partner is already receiving the age pension and the other makes a downsizer contribution to their accumulation super, The rules around when that super becomes accessible depend on the contributing partner's age relative to pension age. For couples where one partner has reached pension age and the other has not, a downsizer contribution by the younger partner goes into exempt accumulation super and does not immediately become accessible. For couples where both have reached pension age, the contribution immediately becomes accessible in the pension assessment because accumulation super belonging to a person over age, pension age is always counted. Before selling your home and making a downsizer contribution as a couple, understanding exactly how the contribution interacts with both your current and future Centrelink position is essential. The fourth thing is to check both partners' work bonus balances and understand how they interact as a couple. New pensioners now start with a $4,000 opening balance in their work bonus income bank. The work bonus allows age pensioners to earn up to $300 per fortnight from employment without it counting in the income test. Unused work bonus accrues up to a maximum of $11,800. For a couple where both partners are receiving the age pension, each partner has their own separate work bonus bank. This means that as a couple, you can collectively shelter up to $22,400 in accumulated work bonus from employment income assessment, provided the amounts are distributed reasonably across the two partners. For couples approaching retirement who are thinking about whether either of them should do any part-time work in retirement, the work bonus makes a meaningful amount of employment income possible without affecting the pension. But the strategy works best when both partners understand their individual work bonus balances and plan their employment income accordingly, rather than one partner burning through their entire work bonus balance while the other's accumulates unused. The fifth thing is to understand the age gap opportunity before it closes. This is the most powerful and time-sensitive strategy available to couples approaching retirement, and it is one that most people have never heard of. If there is an age gap between you and your partner, the older partner may have already reached pension age, while the younger partner has not. In this situation, the younger partner's superannuation held in accumulation phase is completely exempt from the Centrelink assets test and also not subject to deeming under the income test. This creates a window of opportunity. During the period when the older partner is receiving the pension and the younger partner's accumulation super is exempt, the couple can contribute additional funds into the younger partner's exempt super using the bring forward rule, reducing the combined assessable assets that affect the older partner's pension. Utilizing the bring forward provisions, you can contribute up to $360,000 into your younger spouse's superannuation account. Moving $360,000 from the assessable environment into your younger spouse's exempt super account can increase your age pension by up to $14,040 per year. Over a typical retirement of 15 to 20 years, that additional pension income compounds to a total difference of $210,000 to $280,000 in retirement income that would otherwise have been left unclaimed. The window for this strategy closes the moment the younger partner reaches pension age and their accumulation super becomes accessible. For couples where that closing date is approaching September 2026 or shortly after, acting before September is genuinely urgent. Now, let me address the most common mistakes that couples approaching retirement make, because understanding what not to do is just as important as the positive strategies. The first mistake is assuming the pension is calculated per person and failing to account for the joint assessment. Many couples look at the individual pension rate, see that a single person receives $1,200.90 per fortnight, and assume each of them will receive something like that amount. In reality, the couple rate is $905.20 each per fortnight, and is calculated against their combined means, not each person's individual means. A couple whose combined assessable assets are $800,000 is significantly above the full pension threshold of $499,000, and receiving a substantially reduced part pension, even if those assets are evenly split, and each individual would appear to be below the individual full pension threshold if assessed separately. The couple rate is lower per person than the single rate, and it is assessed against a combined means test. Understanding this distinction before you reach retirement age is essential for realistic planning. The second mistake is waiting until both partners have reached pension age before doing any structured planning. By that point, the exemption window for the younger partner's accumulation super has closed, the bring forward contribution opportunity may have passed, and the asset structure you have entered retirement with is effectively locked in for the foreseeable future. The planning that makes the most difference for couples happens in the 5 to 10 years before reaching pension age, not at or after retirement. The difference between an optimized strategy and a default one can easily be $5,000 to $15,000 per year in additional retirement income. Over a 20-year retirement, that is $100,000 to $300,000 in total income that most Australians leave on the table. The third mistake is not understanding the interaction between one partner's Centrelink assessment and the other partner's super. If your partner has not yet reached pension age, their superannuation is not counted in your combined assets test. But the moment they turn 67, their entire super balance enters the assessable pool immediately, potentially pushing your combined assets above a threshold and reducing or eliminating your pension without any other financial change having occurred. Couples who are not tracking the younger partner's approach to pension age and planning for the impact of their super becoming assessable can face a sudden and unexpected reduction in their pension payment on a specific date that was entirely foreseeable. The fourth mistake is failing to apply for the pension as soon as the older partner turns 67 because the couple assumes they will not qualify due to their combined assets. The June 2026 thresholds confirm that a homeowner couple can have combined assets of up to $1,102,500 and still receive at least a part pension. Based on Australian Retirement Trust data, roughly 39% of Australians over 67 receive the full age pension, and a further 24% receive a part pension. That means 63% of Australians over pension age are receiving some pension payment. Many more would qualify but have not applied because they assumed they would not. Even a small part pension provides access to the pensioner concession card, which is conservatively worth $3,000 to $6,000 per year in reduced costs for a typical couple. Failing to apply because you assumed you would not qualify without actually checking is one of the most costly retirement planning errors a couple can make. The fifth mistake is not understanding the impact of one partner dying on the surviving partner's pension assessment. When a partner dies, the surviving partner transitions from couple assessment to single assessment. The combined assets that were supporting a couple's pension are now assessed against a single person's thresholds, which are significantly lower. This transition can result in a sudden reduction in the surviving partner's pension or even complete loss of eligibility at exactly the time when that person is already dealing with grief and significant life disruption. Understanding this transition in advance and planning the asset structure accordingly so that the surviving partner is in the best possible position is a conversation that couples approaching retirement should have proactively rather than leaving to chance. Now let me walk you through the practical steps for September 2026 specifically. The first step is to calculate your combined assessable assets and income using the 1 July 2026 thresholds. Write down the actual number, compare it to the couple thresholds, know where you stand today before September changes anything. The second step is to watch for the September 2026 threshold announcement, which will be made in late August or early September. When the new thresholds are published, recalculate your position against the new numbers. If your combined assets sit near a threshold boundary, the September update may change your pension entitlement, and you will want to understand the impact before it hits your bank account. The third step is to check whether the younger partner's super is still in the exempt accumulation phase and, if so, assess whether any bring forward contribution strategy makes sense before the younger partner reaches pension age. If the younger partner is approaching 67, this window may be closing in months rather than years. The fourth step is to review your contribution strategies for the 2026-27 financial year in light of the updated caps. The concessional cap is now $32,500 and the non-concessional cap is $130,000 with a $390,000 three-year bring forward option. If you have surplus cash or accessible assets that could be contributed to the lower balance partner's super before the window closes, this is the year to act. The fifth step is to apply for the age pension for the older partner on the day they turn 67, if they have not already done so. Do not wait, do not assume. Check your actual eligibility against the current thresholds and apply if there is any possibility of receiving even a part pension. The pensioner concession card alone is worth the application. And the sixth step, which is the most important of all, is to speak with a licensed financial advisor who specializes in retirement income and age pension planning for couples before September 20th. The interaction between your combined super balances, your asset structure, the joint Centrelink assessment, the exemption window for accumulation phase super, the bring forward contribution rules, and the September threshold update is genuinely too complex to navigate optimally without professional modeling of your specific situation. The difference between a standard retirement income outcome for a couple and an optimized one can be hundreds of thousands of dollars over the course of retirement. The cost of professional advice is a fraction of that difference. To bring everything together, here is what every Australian couple approaching retirement needs to understand about September 2026. The 20th of September brings simultaneous updates to the part pension cutoff and income test thresholds that directly affect couple pension eligibility. Couples are assessed as a single financial unit regardless of how assets are owned or named. The younger partner's accumulation super is exempt from assessment until they reach pension age, creating a time-sensitive planning window. Contribution rebalancing between partners can reduce combined deemed income and increase pension entitlement by up to $14,040 per year. The updated non-concessional cap of $130,000 and bring forward of $390,000 provide powerful tools for asset repositioning before the exemption window closes. The gap between an optimized couples strategy and a default one can easily be $5,000 to $15,000 per year or $100,000 to $300,000 over a full retirement. And the planning that makes the most difference must happen before both partners reach pension age, not after. September 2026 is not just a threshold update. For couples in their 60s approaching retirement, it is a planning marker. A moment at which decisions made before it either position you well or leave you with a suboptimal outcome you will live with for the next 20 years. The window is open right now. Use it. If this video helped you today, please give it a thumbs up because it genuinely helps more Australian couples find this information when they need it most. Share this video with every couple you know who is approaching retirement age because the September planning window is real and most couples have not heard about it. Subscribe to Centrelink Insider AU because we are here every single week covering everything that affects your retirement income. And drop a comment below and tell me whether you and your partner have already started planning for the Centrelink joint assessment or whether this video changed how you are thinking about it. I read every single comment and your questions shape what we cover next. Until next time, stay informed, stay protected, and take care of each other.